Right. So back to our Sharpe ratios. So what does it all these numbers mean in the grant context? So in particular, so let's look at comparisons to some Sharpe ratios historically. All right. So now these returns, as you can see, they're the first two columns. Well, after the time period, the average annual returns, they're in annual terms. So they're not quite comparable to the monthly returns that we've done before. But the Sharpe ratios are, however, comparable. And so let's look at the last column. So 1926 to 2015, which is an almost a 100-year period, the Sharpe ratio was 0.40. So that is for every 1% of increase in volatility, excess return would increase by 0.4%. Just to put things in perspective, the numbers that we saw for Apple was 0.3 and so on. So for the period 2010 to 2018. So, remember that a large part of the time period was the Great Recession. So to keep in mind. However, as we saw, for the S&P 500 from 2017 to mid of 2018 was 0.47, was significantly higher than that. Anyway, 1992 to 2015, 0.44. 1992 is when the US just recovered from the recession that was toward the end of President Bush Sr.'s administration. And but then it also went through the dot-com boom and bust and the Great Recession. So 0.44, this number carries a lot of sub time periods that are quite different. So, anytime you take a large data set, a large time period, an average always takes out some of those variations, and that's the nature of an average. That's just how it is. 1970 to 1991 is 0.29. Remember the 1970s, especially the second half of the 1970s, was a very bad time for the US economy with stagflation and so on. 1948 to 1969, that is the post-war boom, where the US economy was just absolutely boomed. And so the Sharpe ratio was 0.65. So for every 1% increase in volatility, the average excess return would increase by 0.65%. That's incredibly good. 1926 to 1947, 0.3. You must remember that included the Great Depression. So, but also the boom caused by the Second World War. Ironically, wars can actually cause incredible increase in income and spending. But that's a macroeconomic question, which we are definitely not going to get into. All right, so that's it for Sharpe ratios for now. As I mentioned, anytime you are asked to evaluate a security or an investment or an index, anything, the first thing you should always do is to go calculate the Sharpe ratio. Because without understanding the Sharpe ratio, you really don't even begin to understand, evaluate a security. Now, having said that, the Sharpe ratio is a linear first step. What does it all mean? We are going to get more into the details of what the Sharpe ratio actually can be interpreted as, and then we are going to go into calculating optimal portfolios, where we will see, as we mentioned earlier, that an investment can really be talked about in the context of a portfolio because of the covariances. Okay, so it is not very interesting, except in this very simplified Sharpe ratio perspective, to talk about how good an investment is by itself. The context is really, really important, which we will discuss for the rest of this lecture. Okay, so let's kind of set some terms straight, so get a sense of how this optimal investment ought to work. So in order to do that, let's say you have a portfolio consisting of just two securities, a risky security and the risk-free security, just two, okay? And theta is the proportion of the investment that you've allocated to the risky investment. And theta lies between 0 and 1. All right, it's a proportion. Now, in principle, one can have theta greater than 1, And that's the idea that you can actually have an investment which is more than 100% in the sense of you're going net negative on another investment. That's a possibility, but let's keep it straightforward for now. So what is the return on the portfolio? The return is linear, as we have seen before. So the return on the portfolio equals theta time the return on the risky asset plus 1 minus theta times the return on the risk-free asset, RF. So the expectation, once again, perfectly linear, is theta times expectation of the risky asset plus 1 minus theta times the return on the risk-free asset, RF. Okay, first, expectation of risky, you see that subscript I, that indicates that this is the information with respect to investor I. Remember, the information can be asymmetric. I'm kind of keeping it consistent, trying to make sure you understand what the different informations are, what the different risk aversions are, and so on. And later on, we will make it clearer when we do CAPMs and market models, etc., how those identical investor assumptions will work. All right. So that's the expectation. 1 minus theta RF. First of all, why is there no expectation there? That's the idea of the risk-free asset. It's that in principle, it's known. There is no variation, remember that, but we don't see that in the data. That's the thing about you need to understand why you need to, it's so important to get your hands dirty with the data. RF by itself is really, and conceptually it's incredibly straightforward. But when we actually look at the real world, it's so much more difficult to understand, to comprehend, to evaluate, and so on. So that's what in this case, 1 minus theta RF. It's not only it's everybody has the same information and about RF because it's a constant. So that's why it is 1 minus theta times RF. We don't even need an expectation around it. The expectation of a constant is a constant. So we rewrite this expression to put it in terms that we can actually do something with, is equal to the risk-free return RF plus theta times EI expectation of risky minus risk-free asset. Haha, this is the excess return on the risk-free asset. So the expectation of a portfolio, the expectation of the return on a portfolio equals the risk-free rate plus the proportion of the risky investment times the excess return on the risky asset. Okay, great. It's linear. That's how it's going to be. Volatility of the portfolio, on the other hand, is different. Now, first of all, 1 minus theta times RF, the standard deviation of that is 0. Because that's the idea of a risk-free asset. It's in principle, it's constant. Of course, as we have seen with the data, it's not. And but that's the idea of a risk-free asset. So that's the, these are the kind of, the subtle, well, not really subtle. These are the nuances that you need to get to in order to actually work with the real world, make the translation from theories to real world. All right. So, so this here, 1 minus theta times RF, the variance of that is 0. The standard deviation, therefore, is also 0. So it is, therefore, the risk-free portfolio equals theta times the standard deviation of the risky asset. So the volatility of the portfolio equals theta times the volatility of the risky portfolio. If theta is strictly below 1, that is to say, if the proportion of the investment allocated to the risky investment is strictly less than 1, then the variance, then the volatility of the portfolio is actually strictly less than the volatility of the risky asset. Right? So that's something to keep in mind when you have a portfolio, and that's not surprising at all. Why would you have a portfolio of your risky asset with the risk-free asset? Is to reduce your variance, reduce the volatility of the portfolio. And how do you reduce the volatility of the portfolio? By simply the proportion of your investment that you put on the risky asset. Sorry, my bad. The volatility of the portfolio is equal to the proportion of the investment going to the risky asset times the volatility of the risky asset. So what is the reduction? So sigma portfolio minus sigma risky I equals just 1 minus theta, which is the amount of your investment that 1 minus theta times the proportion. And that's what this is. So theta equals sigma of the portfolio divided by sigma of the risky asset, right? So this reduction is this theta, if it is less than 1, that is the reduction in portfolio risk that you are achieving by getting in, mixing it in with risk-free assets. Okay, so expectation of the risk-free portfolio, we are going to rewrite it as the return on the risk-free asset plus this ratio times the excess return. So then we can rewrite this, and lo and behold, it turns out to be the expected return of the portfolio equals risk-free return plus this animal here, which is numerator is excess return, denominator is the volatility of the risky portfolio. So this here is the Sharpe ratio of the risk-free asset. Okay, so the expectation of the, so let's rewrite this. The expectation of the portfolio equals the risk-free asset plus the Sharpe ratio times the volatility of the portfolio. Okay, that's the linear relationship we come up with. So in particular, if you have a graph such that you have volatility on the horizontal axis and return on the vertical axis, then as you can see right away that the graph will look as the following. The y-intercept, sorry, the vertical intercept will be the risk-free asset, and the slope will be the Sharpe ratio. So if you plot it, once again, you have volatility on the horizontal axis, you have return on the vertical axis. This graph is such that you have the risk-free asset is the vertical intercept, and then the line is, then you have the expected return of the portfolio being a straight line with the constant slope being the Sharpe ratio. Okay, that is called the capital allocation line. When it is the risky investment is a broad market index like the S&P 500, for instance, then that same thing is called the capital market line. Okay, so capital allocation line for a particular security, when it's a broad market index, it's called the capital market line. Remember, once again, this is in the context of putting together a portfolio. So if you, for instance, your portfolio consists of just Apple and the T-bill, then theta is the proportion of your investment that you're putting in Apple. Yeah, and then if you, the capital allocation line for Apple will be the risk-free asset with a straight line which has the Sharpe ratio of Apple. For Google, the capital allocation line is has the same vertical intercept, because the risk-free asset does not change from security to security. So for Google, it will have the same vertical intercept, but the slope will be the Sharpe ratio for Google. All right. Similarly, for if you want to do it for the S&P 500, and then going back to the previous slide, if your portfolio just consists of the S&P 500 index on one hand and the risk-free asset on the other hand, and theta is the proportion of your money, of your investment that you put on the S&P 500 index, yeah, then what is the capital allocation line for the S&P 500? That is what we'll call the capital market line. And then once again, the vertical intercept does not change. That's the same for the S&P 500 index and the risk-free rate asset portfolio as well. So the vertical intercept is still the risk-free asset. However, the capital market line has the slope, which is given by the Sharpe ratio of the S&P 500 index. All right. Now, once again, if you want to do, as we saw, the Sharpe ratio for the S&P 500 in the 2010 to 2018 June period was about, I think, 0.23, whereas for 2017 to 2018 June was about 0.47. So as you can see, one will be significantly steeper than the other. Now, you'll have to be very careful about doing Sharpe ratios across capital market lines or capital allocation lines across two different time periods, because the risk-free rates will not necessarily be the same anymore. Okay, so always keep that in mind. The risk-free rate, all of this we're doing, the theory says the risk-free rate remains the same, but they're not. So you will have to be careful, which is why when you're doing, if you're doing the capital allocation, the capital market line for two different time periods, the risk-free rates will be different for the two, the y-intercepts will be different. All right, so to reaffirm what we just mentioned, if you're talking about the capital allocation or the capital market line for a particular time period, all of them have the same y-intercept, whereas you have different slopes. So for instance, Apple will have the steepest, then you have the S&P 500, then you have Google, and the Navigant slope will be pretty close to zero, pretty close to a flat line. All right. On the other hand, now if you want to do a similar capital market line for a different time period, the vertical intercept itself will change because the risk-free rate will change from time to time. Those are the intricacies that we have to be aware of when we're working with actual data. Okay, so having said that, now we have set up the framework to actually go deep into optimal allocation of risky investment. Okay, so what is the variance, as we saw earlier, of this simple portfolio is going back to that, what we said earlier, that the variance of the risk-free asset is zero in principle, right? So the variance of the portfolio is simply equal to theta squared times the variance of the risky investment. Quadratic utility. Remember, we said that quadratic utility is very popular in finance. The reason is that it's actually easy to do things with it. There are more complicated utility functions out there, which are appropriate for certain purposes, but in finance, we largely restrict ourselves to quadratic utilities because of this very simple relationship between risk and return. Okay, remember what we said earlier, better the higher the return, better the investor. Higher the volatility, worse off the investor. How do we trade those two off? And that's where the quadratic utility gives us a very simple trade-off, is this AI, the A parameter. And this is, remember earlier, the EI represents the fact that different investors can have different information. You can have the same value, but different information that is given by the EI. AI, on the other hand, is different private value altogether. EI is private information, AI is private value. How you value a risk versus return is entirely yours. Even though if you and I have exactly the same information, we could value a portfolio differently because of our different risk aversions. Okay. Once again, so that can very much be the case, and so this is why we are going to subscript the expectation by investor I and the quadratic utility parameter by index I as well. AIs can be different, and we will discuss that shortly. First of all, make sure you understand if A is equal to 0, then this term here vanishes. Then utility is purely a function of the expected return. So this is the case of a risk neutral investor, where the investor only cares about the average returns. So for instance, the fact that Alibaba has lower returns than some of its comparables, if you are a risk averse, if you are a risk neutral investor, then yes, Alibaba would be a worse investment than any of those. But as we we'll see, there is much more nuance, there is much more risk aversion involved, and not only that, risk aversion can be quite different from individual to individual, from investor to investor, from institutional investor to individual investor, and so on. Okay, so there are many nuances which we will talk about in this particular context. So once again, it's great to have this quadratic utility function. So this EI, remember the quadratic utility is equal to expected return minus half times AI times the variance of the portfolio. So So what is the, so let's put in the variance that what we have discussed. EI of R is R of F plus theta times expectation of the risky asset minus the risk-free asset. So theta times the excess return according to investor I's information plus half times AI times the variance. So this here minus half times AI, sigma I star is equal to simply the portfolio of the investor of the portfolio, the variance of the portfolio. So this here is RF plus theta times the excess return of the risky investment minus half times AI times theta squared times the variance of the risky investment. Okay, so therefore this is the utility, and that's what we are going to maximize with respect to theta, because that is your variable of control, which you can then choose between theta being between 0 and 1. And so this here is RF plus this is what you're going to maximize with respect to theta. So going back to microeconomics, you take the derivative with respect to theta and set it equal to 0. So if you go back to the previous equation, this is this here, you take the derivative of this here with respect to theta and you set it to 0. This is the expression you get, and then you solve for it, and the optimal investment turns out to be theta squared equals the expectation of the risky asset minus the risk-free asset. This here is the excess return of the risky asset, or in expectations, that the risk premium of the risky asset, divided by AI, which is the parameter, the quadratic utility parameter, times the variance of the risky asset. Okay. So in particular, this is the optimal proportion of the risky asset is increasing in the risk premium of the risky investment. The more the risk premium, the higher the excess returns, the more you're going to put in the risky asset. Excellent. It's decreasing in the volatility of the risky investment. The more volatile this particular risky investment is, the less money you're going to put in it. Everything else remaining the same. Okay, that's the part we need to talk about and make sure we understand. And finally, it is decreasing in risk aversion. All right, so so the more risk averse you are, the less amount you are going to invest in the risky asset. Okay. Now, as we remember from microeconomics, corner solutions are possible, which we are really not going to get into, except when we do the actual numbers, we will see how these corner solutions are very, very much possible for various different situations. In particular, you can always see if you have the extreme case of risk neutrality, then you will put all your money on the risky asset, as long as the risky asset also has a higher return, as is typically the case, than the risk-free rate. Okay, there is, as I mentioned earlier, you can have theta greater than 1, but let's not necessarily. You can please read it. Now, one of the things that I mentioned to you in your exams, you are only responsible for material that we have actually covered in class. So I always think of the slides as reference material for you to refer to when anytime you're at work. So they don't I will not cover all the slides that I have posted on Blackboard. Okay, so what is the optimal portfolio in general? So you have an investor I consisting of N, a general N candidate securities with shares, theta I1, theta I2, theta IN, and so on. The idea, the restrictions being as earlier, as we said earlier, lying between 0 and 1 and summing up to 1. The expected return on the portfolio is expected return is equal to, similarly, just the linear combination of the expected returns on these various various candidate securities. The variance of the portfolio is as we know, variance is much more complicated because variance is a quadratic function. So it is equal to the theta ik squared times the variances plus this cross product terms of the covariances. Because the variance of a variable with itself is just, sorry, the covariance of a variable with itself is just its own variance. So you can rewrite these this whole expression just in terms of the covariances as well. Okay. So so what is the quadratic utility then? Remember, it is equal to the expected return minus half times AI times the variance. So this entire portfolio, which consists of n candidate securities with theta I1 going to candidate security 1, theta I2 going to candidate security 2, and so on, with the proportions lying between 0, 1 and 1 and adding up to 1. This is the quadratic utility. Okay, now going back to what we said earlier, what then, in order to compute the optimal shares, theta I1 star, theta I2 star, theta IN star, just for investor I, will require information about this expectation and all these covariances. How many parameters is that? It's equal to n, which is the number of expectations. Going back to the previous equation, so you need information about the expectations of each of the candidate securities. You need the variances of each of the candidate securities, and you need the covariance terms. So the total means are these n, total variances are these n, and the covariance terms are n times n minus 1 over 2. That is something you should verify on your own, and could be something that could be on your exam, for instance. Tell me why the number of why this is the total expression. I've already walked you through a large part of the hint, but in order to complete it, you need to know the rest. What does it all mean? So if we were to include all US listed equities in our candidate portfolio, we would need information about 12.5 million parameters. This is just for one investor. For one investor, if you're trying to calculate the optimal investment portfolio for that one investor, and if the candidate securities is each, not the whole market, this is the part to remember. It's because in the in the S&P 500, the markets, the weights are predetermined, but here you are determining the thetas for each particular component of your investment portfolio. Okay, so if you were to do that, then you would require 12.5 million parameters. That is computationally impossible, which is why you don't see investment advisors specializing in the entire market. You always have investors specializing in industries, advisors specializing in small cap, large cap, global, various industries, sub-industries, growth, dividend paying, all kinds of various different specializations, because for this particular reason, because if this is a quadratic function in the number of candidate securities. So it increases very, very quickly. So the only way to really do anything interesting is to have strong limitations on the number of candidate securities. All right, so let's now apply everything that we have done to actual calculations of optimal portfolios. All right, so now let's say you have a situation where Apple and the risk-free asset are your only candidate securities. All right, let's say, what do we have? Let's start with them having equal assets, equal weights on the assets. So what is this? This is equal to monthly return on Apple times the share of Apple plus monthly return on the US debt times the share on the risk-free debt. Okay, that is the, if you were to have equally weighted returns on these two, this is what your monthly shares would be, linear. Now, if you want to extend this all the way, remember what you would have to do is to put dollar signs around these, otherwise you won't be able to move that around all the way. Now you let it populate it all the way. Make sure we got it. Yeah, E104 times H2 plus F104 times I2. So this here is the monthly returns for the constructed portfolio. Okay, this here is the average of the constructed portfolio, J3 to J104. The standard deviation, J3 to J104. This here is the variance, which is the square of the standard deviation. Okay. Now this here is the utility of the constructed portfolio, which is equal to the average of the returns minus half times this parameter times this variance of returns. This gives you the expected utility of this particular portfolio, consisting of 50% share of Apple and 50% share of the risk-free asset if the parameter of the quadratic utility function is 0. What is 0 once again? It's a perfectly risk-neutral investor. Okay. All right, now we are going to, earlier we had done, we had showed how to calculate the investment portfolio that causes the minimum volatility, the best diversification. But here we are now taking it a step further. We are actually talking about optimal investment. All right, so remember, with optimal investment, better the return, higher the return, better off you are. Higher the volatility, worse off you are. This parameter lets you trade off between the two. When it is 0, the extreme trade-off, that's where you're just saying, all I care about is the average return. That's risk neutral. Let's do it for it, and then we'll change, we'll do our comparative statics. So this here, now I'm going to show you how to do the optimal investments. So once again, the thing that I do want to emphasize to you is that this here, in this course, Excel is just a means to the end. It is not what you're going to be tested on. It is not what you should be learning from this course. It is a means to understanding and applying finance. All right. So in particular, if you end up going from here to Goldman Sachs, if you're in the trading floor of Goldman Sachs, you should be able to hit the ground running because of all this stuff that we are doing here. All right. Our objective is to maximize this particular object, which is L107. So to do that, go to data, solver, and we say, let's say, what is the objective? Go to this and say, this is my objective. All right. By changing variable cells, H through I. Okay. Let's just delete all of these and recreate them. All right. So, so we are setting objective L107 by changing variables H through to I2, subject to the constraints. A, first, this is less than or equal to 1. Add this less than or equal to 1. Now, there is that greater than or equal to 0, which actually Excel lets us do that and add its, we don't actually have to explicitly add that on. I'll show you that in a second. And they have to add up to 1, which I can rewrite as 1 minus H2. Okay, so you see this check mark here, make unconstrained variables non-negative. you could either add the constraints here in the subject to the constraints, or you can just check this, because that's the great thing about, because there's so many of our constraint optimizations tend to be with non-negativity constraints. So that's something that's a standard put in within Excel. So let's make sure we have it right. Our objective is to maximize L107, the utility of the expected utility of the constructed portfolio, by changing variable cells H1 to I2, subject to the constraints that H2 is less than or equal to 1, I2 is less than or equal to 1, and I2 equals 1 minus H2. All right, we think we're good. We might, so click on solve, keep solver solution, click OK. Look at this. We have a corner solution. If you are risk neutral, and then if you have this two candidate portfolio, you will put all your money in the one with the higher risk. You will put all your money on the security with the higher expected return, because you don't care about the volatility. You are purely risk averse. That's what this parameter being being 0 says. Okay. What if the parameter is 1? This here is the expected utility of this constructed portfolio. Now we are going to come up with, we are going to estimate, we are going to calculate the optimal shares, the optimal proportions in Apple and the risk-free asset that would give you the maximum utility. Now, one thing you should keep in mind, going back to microeconomics, the expected utility number by itself does not mean anything. Utility is an ordinal variable. That is to say, only thing that matters is comparison across two different utility numbers in a particular situation. The actual utility number doesn't mean anything. And we'll see in a bit later where this number is, for instance, negative. That doesn't mean it is worse than something, because what does you have utility 0? Okay, if it is negative, it means it is worse than something with utility 0. It's only worse than something with utility 0, which may not be like not investing at all. Okay, so it's a completely something about comparison. So that's something you need to keep in mind. All right, so whether it's 1, going back to solver, and we say, okay, what are we going to do? Set objective L107 by changing variable cells H2 to I2 less than or equal to 1. I2 is less than or equal to 1. The two add up to 1. We are saying they need to be greater than or equal to 0. Hit solve. Okay, it's still 1. And the reason is, even if you are reasonably risk averse, what does that 1 mean? It means, going back to that expected utility, quadratic utility expression, it is expected return minus half times the quadratic utility parameter times the variance. Yeah. So, the interpretation is simply it's an idea to vary around how much it changes across different investors, or even for an investor across time, and so on. Okay, so let's say we make it 10. All right, now this is a person who is significantly more risk averse, so they really care a lot badly about the volatility. They get very upset when the portfolio is very volatile. That's the risk investor with a quadratic parameter of 10. So as I mentioned earlier, the expected utility in this case is negative 0.3%. Okay, we have to be very careful. Negative 0.3% is clearly worse than a portfolio with expected utility 0. But what is that expected utility? What is that portfolio with expected utility 0? It is not the same thing as, for instance, not investing at all. Okay, so from this you cannot conclude that this here is a worse investment. It just, this portfolio is a bad investment. Okay, it's bad compared to what? Going back to our data, go to solver. And once again, our objective is to maximize L107 by changing variables H through to I2, subject to all those constraints, solve. Now it has changed. Okay, so the parameter of the quadratic utility function is 10. You're a much more risk averse investor, in which case, if it is 10, you only put 43% of your money on Apple and 57% of your money on the risk-free asset. What I mentioned earlier, no investment, no security is an island. It's really not that meaningful to talk about whether a particular security is a good investment, except in that very simplified idea of a Sharpe ratio, because it depends on what else are your alternatives because of that covariance term. All right. So in this case, you know, there is a significant, you're significantly risk averse. You'll only put 43% of your money on Apple, despite the fact that Apple's return, 2.13%, is significantly higher. Sorry, Apple's return of 2.15% is significantly higher than the average return on the risk-free asset. But since you are very risk averse, you care very negatively about the risk, your optimal ratio is to put 43%, optimal investment is to put 43% of your money on Apple and 57% of your money on the risk-free asset. What if you're even more risk averse? Okay, it's 100. So remember, actually, let me just make it 200. Then going back to our expected utility, remember, the quadratic utility is the expected return of the portfolio minus half times AI times the variance. Okay, so if AI is 200, then this here half times AI is 100. That means you're putting 100 times more weight negative on the variance than you're putting on the expected return. Okay. It's something to keep in mind, but what does it mean that your parameter is something, my parameter is something? All I can say is if I am more risk averse than you are, then my AI will be higher. So in this case, as we can see here, the expected utility is negative 8.2%. Once again, doesn't mean this whole whole portfolio is a bad investment. Okay. So going back to our optimization, go to solver. So do this, just as we had before, make sure. Now, if you're that risk averse, you essentially only care about volatility, then you will put only 2% of your money on Apple and 98% of your money on the risk-free asset. All right. So this is what we were seeing earlier. There are corner solutions. As your risk aversion increases, you put more of your money on the risk-free asset, which is why when someone like me, I'm in my 50s, I don't have that many years left. I'm much more risk averse. I will put a larger portion of my assets in cash than I would in risky securities. All right. So this enables you to actually understand with actual data how this optimal investment works. All right. So similarly, if you're doing it with Google, if the parameter is 10, then we can see that the optimal share of your investment in Google is 31%. The share of the risk-free asset is 69%. And if you see if it is 0, let's see what happens. As we saw earlier, if you are completely risk neutral, then this here is the expected utility of this portfolio, where 100%. So then if you're risk neutral, you solve for it as we had earlier, and we see what 100% of your assets go to the risky asset. All right. So and so on. Now let's make it a bit more complicated, where you have more than 2 candidate securities. So you have Apple, S&P 500, and the risk-free asset. All right. So these are the only three candidate securities, and you are trying to optimize your investment. So just as we did earlier, we calculate the monthly returns of this constructed portfolio. This here gives you the expected utility, M107, which is the average, minus half times N2, which is the parameter of the quadratic utility function times M113, which is the variance. Okay, so we got it right. So let's first say, what if your parameter is 0, where you are risk neutral? So go to data, just we had earlier, we say 007. Actually, let me just show you how to do it. 007 by changing variable cells, these three. Then you have J2 less than or equal to 1. Let me just delete all of these to create. All right. So we'll first add the constraints. This has to be less than or equal to 1. Add another constraint. K2 less than or equal to 1. Add L2 less than or equal to 1. Add L2 equals 1 minus J2 minus K2. Do we have all of them? All of them are less than or equal to 1. They actually add up to 1. We are going to check this to make this unconstrained, they make the variables non-negative. Hit solve. Okay. And so in this case, we can see that even though the is 0, we see an interior solution. All right. Now, this is where it gets very interesting, because once again about the covariances. All right. So that's something we should always keep in mind, that, you know, what does it mean for Apple to be a good investment, or what does it mean for the S&P 500 to be a good investment? Well, it depends on the context in which we're doing. All right. What if the share of the parameter of the quadratic utility function is 10 instead? All right, then let's go to data solver, just as we had done. Make sure we're getting everything right. Set objective is, 007 by changing variable J2 to L2. Solve. The share of Apple is 32%. Share of the S&P 500 is 46%. Share of the risky asset is, okay, let me make sure I'm getting this right. M107 minus N2 times M130. What if it is 200? All right. So now that is, once again, negative doesn't necessarily mean that it is a bad investment. Set objective 007 by changing variables J2 to L2, J2 less than or equal to 1, K2 less than or equal to 1, L2 less than or equal to 1. They add up to 1. Solve. Okay. And if you are very risk averse, remember, this is when the parameter is 200. It means you care about the variance of the portfolio 100 times more. 100 times more badly than you care about the expected return. Very, very risk averse, in which case you'll only put 2% of your money on Apple, only 2% of your money on S&P 500, and 96% of your assets on the risk-free asset cash. Okay, let's make this a bit more interesting, and where we have 4 candidate securities. Apple, which is, as we have seen, a solid security, 0.3 Sharpe ratio. Tesla, which is very high return, but also high volatility. The market over this time period is like 0.23. It is lower volatile, its expected return is lower than Apple or Tesla, but its volatility is also lower than those two equities. But the risk-free asset is, now these things just kind of, let's start with equal proportions. All right. And let's figure out what the parameters, what the optimal portfolios will be. All right. So in order to do so, like we did earlier, we create this constructed portfolio with the return of the portfolio depending on the returns of the individual securities multiplied by the shares of those individual securities. That's the constructed portfolio. From that, we obtain the average of the constructed portfolio, the volatility of the constructed portfolio, and the variance of the portfolio, constructed portfolio. This here gives you P101, which is the average of the portfolio, minus half times Q2, which is the parameter of the quadratic utility functions, times P107, which is the variance of the utility function. All right, we got that. Let's go to data, go to solver. What are we maximizing? R101 to max, L2 less than or equal to 1, M2 less than or equal to 1, N2 less than or equal to 1, O2 less than or equal to 1. They add up to 1. We have them as greater than or equal to 0 here. You don't have to. You can just use this check to do that. Click solve. So if you are very risk averse, if the parameter of your quadratic utility function is 100, then not surprisingly, you have very little portion of your money in Tesla. You have higher proportion of your money on Apple because it has lower volatility. The market index has even lower volatility, so it gets 6%, but the risk-free asset, which is very low volatility, gets almost all of your money. What if it is 0, where you are completely risk neutral? Just as we did before, this here calculates the expected utility of this constructed portfolio if you are perfectly risk neutral. So once again, you go to solver, make sure we're doing it right. You're maximizing R01, max, L2 through O2, all of this hold as before, click solve. When you are completely risk neutral, you put all of your money on Tesla because it has much higher returns than any of the others. Let's consider kind of a medium case where the quadratic utility parameter is 10. And once again, the expected utility is negative. Once again, not to conclude from that the entire portfolio is bad. Go to data, solve, and we say, if this is the quadratic utility parameter, 10, we are going to maximize R101 subject to all these constraints, as we have mentioned before, solve. And this is an interesting interior solution. Well, it's not fully interior because the share of the risk-free asset is 0. The share, now this is the thing, you are quite risk averse. The S&P 500 has lower volatility than either of these securities, so you have a large portion of your money in the in-market index. Tesla, which is quite volatile, but does have a higher high excess high return. So your optimal portfolio is to give it 12. Apple is 27%. And the risk-free asset, you get 0%. Why is that? Once again, because of the covariances. All right. So once again, to kind of drill home the idea that when you talk about Sharpe ratios, that's a simple first approximation at how good an investment is just a function of the excess return of that security with its volatility in the denominator. Okay, that's just a starting approximation. You have to do that. But the optimal portfolio, your optimal investments, is much more complicated because it really isn't to be considered in the context. What are your alternatives? All right. So as we can see here, and that depends on the trade-off that you have between risk and return, which your trade-off can be quite significantly different than mine. All right. The Sharpe ratio, remember, it can be different for investors when they have private information, but it does not depend on private valuation because your risk aversion does not enter into the picture of the Sharpe ratio. From Sharpe ratio, when we go on to optimal investments, we are getting onto private value, the private risk aversion, which can be different between investors. And then we see some very interesting results that happen because of these covariances that occur between these various investments. All right. Well, hope you have a great rest of the week, and I will see you next week. And also hope you have a great weekend.